Well, good morning, everyone. Today is Monday, June 29th. My name is Brennan Derone, Chief Distribution Officer for E4 Insurance Services, and you are attending The Brew, building relationships every week. Want to keep things quick today as we've got a lot of exciting information. We'll do a quick rundown of today's calendars. Today is National Almond Butter Crunch Day. So, can't say I've ever had that. I'd have to try to order some online and get it at some point. This is also National Camera Day, so take some pictures or some selfies. And National Waffle Iron Day. So, there you have it. Not sure that they all really fit together, but that is our list of days. With us today, we have both Craig Geiger and Bob Vashko. Bob, if I pronounced your last name incorrectly, I apologize. Both from Lincoln Annuities. And with that, Craig, I'll hand it over to you.
All right, thanks, Brendan. Hey, appreciate the time, and thanks everyone for joining today's call. Just real quickly, I just want to give a quick overview of what we're going to cover today. We're going to start walking through the Secure Act and really not so much of some of the stuff that it took away, because obviously it took some planning opportunities away, but it also created new planning opportunities in your practice as well, which we'll go through. And then we'll close things out with the CARES Act that came out more recently, especially during COVID-19, and talk about some of the opportunities that also created with some of your existing and prospects going forward. So with that, just to make sure we stay within time, I'm going to throw it over to Bob, and he's going to walk us through the Secure Act, some of the opportunities, the CARES Act, and then we'll close things out. Bob?
Thanks, buddy, and good morning, everyone. Thank you for taking the time to join us today. What we want to do today, as Craig said, is just go over Secure and CARES. More so Secure because it's kind of gotten lost in the shuffle with COVID-19, like Craig said. And it's a much longer lasting piece of legislation than CARES is. CARES is really just meant for 2020, and then it, kind of goes away. Secure is here, for the long term, ostensibly. And as Craig said, it brought a lot of enhancement to the 401k space and the 403b space. Made it a lot easier for small business owners to offer plans and to enhance plans with auto enrollment, auto escalation, auto contributions. But for today, we wanted to focus on what did the Secure Act do for IRA owners. And again, this was big news back in January, but then once February came rolling around and COVID-19 really became prevalent in the U.S., this kind of got, again, lost in the shuffle. So just as a refresher, Secure did make a lot of positive changes for IRA owners, primarily is that they lifted the age cap on making contributions so long as you have earned income. Stop making contributions at age 70 and a half. You can keep on making them at 72, 74, 78, so long as you have earned income to do so. And the other big thing, as we all probably know, is that they changed the RMD start date. If you had not reached age 70 and a half by the end of 2019, your new RMD start age was 72. Now, if you already hit 70 and a half by the end of 2018 or sooner, the old rules were still in effect. But if you did not turn 70 and a half yet in 2019, meaning you turned 70 and a half in 2020 or later, now it's 72. So that's pretty nice. All those things that Congress did that I mentioned earlier about retirement plans, making it easier to offer guaranteed income solutions in retirement plans, making it easier to form MEPs or multi-employer plans whereby your local barbershop and your local hardware store and local pizzeria can band together and make a group 401k. All that stuff costs money by the federal government. In fact, all these things I highlighted, the 401k stuff and the IRA owner stuff, was going to cost Congress, in terms of the tax incentives and the lost tax revenue, about $16 billion over the next 10 years. And they wanted to make Secure ostensibly revenue neutral. So how did they do it? Well, they did it by sticking it to IRA beneficiaries. And as you all probably know, what they really did was they took away the ability to do a lifetime stretch for most bennies who inherit after January 1st of 2020. Now, if you already inherited in 2019 or earlier, all the old rules still apply. If you were stretching, you can keep stretching. But if you inherit on or after January 1st of 2020, now most bennies can only have an out in 10 rule, meaning they can take out the money at whatever schedule they want to, so long as that account is empty by the end of 10 years. Now, that's not awesome. I mean, lifetime stretch, I think, is a lot better. You had maximum flexibility in terms of access to your cash, but you also had maximum flexibility in terms of lowering your taxable income in any year you wanted to by virtue of RMDs. But that's all gone. And Congress Congressional Budget Office calculated that by removing this lifetime stretch for most bennies, it will recoup that $16 billion that it lost by giving the 401k plans those enhancements and by tweaking the RMD stuff for the IRA owners. So that's how they kind of balance things out. They'll make $16 billion off of truncating the stretch options, and they'll use that $16 billion to pay for the 401k enhancements and the RMDs for IRA owners. Now, as I mentioned earlier, most people can't stretch anymore, and a lot of vendors have stopped taking or will stop taking stretch IRAs because they've made a decision that it's not profitable to take accounts where we know the account is going to leave in 10 years no matter what. So there's a shrinking number of vendors out there that will take a stretch, or I should say an out in 10 Benny IRA. Lincoln is still one of those. We're still happy to take that business. So if you do have a carrier who is, a client who is looking for a carrier that will take an out in 10 stretch IRA, talk to Craig, talk to Lincoln. We're still happy to take that business. Now, as I mentioned, there are some exceptions to stretching. All the people you see on the screen right now, disabled, chronically ill, surviving spouse, minor owner of the participant while they're a minor can still stretch, and number 5, bennies who are not more than 10 years younger can still stretch, and that's usually surviving siblings. So there are some exceptions there. You should know what those exceptions are. Again, the biggest, most obvious one is surviving spouse, but there are some options for people, again, who are disabled, chronically ill, minor kids, and so forth. Now, I want to take that and pivot on over to CARES Act in my remaining 5 minutes. I want to keep us all on time. Now, as I mentioned before, CARES is kind of the big piece of legislation, large and in charge, because it was crafted kind of in a hurry in response to COVID-19, because the market, started heading down around February 19th. We were at our peaks. We've come down since then. I think right now we're down about 9% from our all-time highs in February. And that's kind of the big one right now. Again, it's only for 2020, so it should hopefully, fingers crossed, kind of go away by the end of this year. But it did offer some relief for small businesses. So if you do have a small business owner client, make sure you talk with them about various things that CARES Act does for them as a business owner in terms of payroll tax credits, employee retention credits, and so forth. But as far as for individuals, you see that there was, first and foremost, those coronavirus checks. They've been coming out now for about 2 months, maybe 2.5 months. Gave about $1,200 out for an individual, $2,400 for a joint father, $500 extra for each dependent child. There were income phase outs. I mean, if you made too much money, you didn't get a check. So if your client said, hey, you know what, I didn't get my coronavirus check, or I did, but it wasn't as big as I thought it was going to be, check their income, check their AGI and see if that was why they didn't get their check. The other thing that they did with CARES is they waived RMDs for 2020. So you don't have to take an RMD, whether you're an IRA account owner, a qualified retirement plan participant, or a stretch Benny. You don't have to take your RMD. If you did take one out, you can put it back in as late as August 31st of this year. Ever since this piece has been published, the IRS has actually tweaked CARES, whereby now even IRA bennies who took their RMD, up until last week, they couldn't put the RMDs back in. Now they can. So anyone who took an RMD can put it back in as late as August 31st of this year. There's also talk that they are going to push back the tax filing deadline from July 15th to August 31st as well. So if you have someone who took an RMD and they didn't need it or didn't want it and said, I didn't know about CARES Act, they have an opportunity to put that money back in if they want to, again, as late as August 31st. And they don't have to abide by that 60-day window. They've got kind of a float until the end of August. So that's good news if you didn't want the RMD. But, you know, the market's down, people are out of work, they may need that RMD, especially if they're a Benny and they're out of work. So the other thing that CARES did is that they did allow you to tap your IRA or your 401k, even if you're under 59 and a half, without a 10% penalty. And if you're taking it from your 401k plan, no mandatory 20% withholding. So if you are out of work or you're having what they call an adverse financial consequence related to COVID-19, and that means that you, your spouse, or a member of your household either tested positive for COVID-19 or one of y'all has been laid off, quarantined, furloughed, had your hours cut. If you're a business owner and you had to cut hours or shut your business down, you're eligible to take money out of your IRA or your 401k up to $100,000 aggregate, again, with no 10% penalty. And again, if it's coming from a plan, no mandatory 20% withholding. And you have the ability to pay the taxes back ratably over 3 years. So to keep the math simple, if you took out $60,000 today because you needed to, you can recognize $20,000 for tax year 2020, recognize another $20,000 for tax year 2021, and then recognize the final $20,000 in tax year 2022. Or you can roll it all back in if you want to within that 3-year time frame as well. So you have a lot of flexibility to get the money out if you need it because you were hit by COVID-19 economically, but you also have a 3-year window to roll that money back in if you decide I didn't need it or I didn't need as much as I thought I did. So we have these two pieces available for reference. This CARES Act piece is actually going to be updated this week to accommodate the changes the IRS made with RMD schedules and rolling RMDs back in. But great planning points for your clients to make sure that they know what their options are, especially if they've suffered some kind of economic loss through CARES. So I'm at time. Craig, buddy, I'm going to hand the floor back to you to kind of bring us on home. But I thank you all for your time and attention, and I hope you all have a great week.
Thanks, Bob. And just kind of wrap things up again, you know, I think 3 planning opportunities are coming out of this. One, obviously, is the beneficiary IRA stretch, being that Lincoln's one of the few carriers out there that allow you to do the full 10-year stretch. Also, Roth and partial Roth conversion opportunities. There's a lot of people that have a lot of IRA money, and they've been wanting to do a Roth conversion, but let's face it, they didn't want to do it the last 11 years because the market was up and they didn't want to deal with that tax burden. But now, you know, now might be the opportunity where values maybe are a little bit down, you know, tax rates are still relatively low. Maybe it's an opportunity now to start doing a Roth or even a partial Roth conversion over a number of years to kind of stretch out that tax burden. And then lastly, the COVID-19 withdrawal option, obviously out of an IRA or 401k. So some great opportunities, some great things to kind of reach out to clients and kind of, you know, when you're getting back in front of clients, you're doing reviews or, you know, you're in front of a prospect for the first time, kind of doing the discovery of their assets. You know, 3 really good planning opportunities for you right now in this market. So with that, I'm going to throw it back to Brendan to close us out.
Well, thank you, Craig and Bob. A lot of good information there. Some of it a little heavy. If you have questions, you know how to unmute yourself. Now is your time to ask. We're going to assume that we're going to go with the standard nobody has questions, so interrupt me if you may. But otherwise, I hope everybody has a great week. Thank you to Lincoln Annuities for the presentation today, and enjoy your 4th, and stay safe.